Good morning, everyone. Next, I will briefly introduce the two companies selected for this financial statement analysis. The first company is Hupseng Industries Berhad, which was established in 1958. It is one of the leading biscuit manufacturers in Malaysia, producing biscuits, crackers, and coffee mix products. For the financial year ended 31st December 2025, the company recorded a revenue of approximately Rm 394.7 million and a net profit of 49.8 million. The second company is Apollo Food Holdings Berhad. Established in 1972, the company is well known for its chocolate, cake, and waffle products, which are sold both locally and internationally. For the financial year ended 30 April 2025, Apollo reported a revenue of about Rm 298.4 million and a net profit of Rm 40.2 million. These two companies were selected because they operate in the same food manufacturing industry, making them suitable for financial performance comparison.
Thank you, Alif. And before we dive into the detailed financial ratio, let's take a look at the overall comparison between the two companies. In terms of revenue, although Hupseng generated higher revenue at 394.67 ringgit million versus Apollo's 298.42 ringgit million, Apollo actually holds a larger asset and equity base than Hupseng. And interestingly, Apollo carries zero funding costs, while Hupseng recorded 26,296 ringgit, meaning Apollo operates almost entirely debt-free. We will also keep in mind that both companies report on different financial year ends, which we have accounted for by using each company's most recent audited annual report. Now, moving to liquidity ratio, this measures how easily a company can settle its short-term obligation, and generally, a higher ratio reflects better short-term financial safety. For the current ratio, Apollo recorded 8.3 times compared to Hupseng 2.11 times. This means that for every Rm 1 ringgit of current liability, Apollo has Rm 8.30 cent of current asset to repay it, while Hupseng only has Rm 2.2 and 11 cent. As for the quick ratio, Apollo again leads with 6.97 times compared to Hupseng 1.63 times, showing that Apollo has significantly more liquid asset to cover its obligation without relying on inventory sales. Overall, Apollo Food demonstrates a much stronger liquidity position compared to Hupseng, proving it has immense resources to pay its creditors when payments are due.
Thank you, Avni. My name is Nadira Munira and we're moving on to profitability ratio. First, net profit margin. Apollo is slightly more effective at the bottom line, generating 0.13 ringgit of net profit for every 1 ringgit of sales, compared to Hupseng's, which is 12.62%. Next is the gross profit margin. Hupseng has a better gross profit margin compared to Apollo's, meaning for every 1 ringgit of sales, Hupseng generates 0.3 ringgit in gross profit. Next is the return on assets. Hupseng drastically outperforms Apollo here. Hupseng ROA is 20.01% and Apollo is 15.16%, meaning Hupseng earns 0.20 ringgit for every 1 ringgit of assets. Next is the return on capital employed. Hupseng ROCE is an impressive 38.49% and Apollo is 20.80%, proving that for every 1 ringgit of capital used, Hupseng generates 0.38 ringgit of operating profit.
Next, I will be presenting the efficiency ratios of Apollo Food and Hupseng. This ratio helps us evaluate how efficiently each company manages its inventory, collect receivable, and utilize its asset to generate sales. First is the inventory turnover ratio. Apollo Food recorded 8.11 times, while Hupseng recorded 8.19 times. This means Hupseng sold and replaced its average inventory about 8.19 times during the year, which is slightly faster than Apollo Food. Next is the average collection period. Apollo Food takes 38 days to collect payment from customer, while Hupseng takes 39 days. Since fewer days are better, Apollo Food performs slightly better. Lastly, the total asset turnover ratio. Apollo Food recorded 1.17 times, while Hapseng recorded 1.58 times. This means that for every 1 ringgit of asset, Apollo Food generates 1.17 ringgit in sales, while Hapseng generates 1.58 ringgit for every 1 ringgit of asset. Overall, Hapseng performs better in inventory turnover, total asset turnover, while Apollo Food performs slightly better in the average collection period.
Okay, now let's move on to the leverage ratio analysis. Leverage ratio measures a company's financial risk by showing how much it relies on debt. In general, a lower percentage indicates lower financial risk. First is the debt ratio. Apollo Food has a debt ratio of 10.63%, while Hapseng records 33.5%. This means Apollo uses much less debt to finance its asset, so it has lower financial risk compared to Hapseng. Next is the debt to equity ratio. Apollo's ratio is 11.89%, whereas Hapseng's is 50.3%. This indicates that Apollo depends less on borrowed funds and more on shareholders' equity, while Hapseng relies more heavily on liabilities. Lastly, we have the times interest earned ratio. Apollo is marked as not applicable because it has no interest expense from bank borrowings. On the other hand, Hapseng has a ratio of 2,534.36 times, showing that it can comfortably cover its interest payments with its operating profit. Overall, Apollo Food is the stronger company in terms of leverage because it has lower financial risk and relies less on debt financing.
Now, I'll provide a summary of the overall financial performance of both companies based on the 12 financial ratios that we've analyzed. Overall, the test results show that each company has its own strengths. Apollo Food performed better in liquidity and leverage. It recorded higher current and quick ratios, showing a stronger ability to meet short-term obligations. It also has lower debt and debt-to-equity ratios, indicating lower financial risk because it relies less on borrowed funds. On the other hand, Hapseng performed better in areas that directly contribute to long-term business growth. It achieved stronger profitability by recording a higher gross profit margin, return on assets, and a return on capital employed. These ratios show that Hapseng is more effective in generating profits from both its asset and the capital invested in the business. In terms of efficiency, Hapseng also outperformed Apollo by recording a higher inventory turnover and total asset turnover, meaning it manages its inventory more effectively and generates more sales from its assets. Although Apollo collected receivables slightly faster, the difference was only a day and not considered significant. Looking at all the 12 ratios together, Apollo performs better in 5 ratios, while Hapseng performs better in 7. More importantly, Hapseng's strengths are concentrated in profitability and operational efficiency, which are the key indicators of long-term financial performance. Therefore, although Apollo is financially safer due to its stronger liquidity and lower leverage, Hapseng demonstrates stronger overall business performance. Based on our financial ratio analysis, we recommend Hapseng's industries Berhad as the better investment choice. The first reason is its superior profitability and capital efficiency. Although Apollo recorded a slightly higher net profit margin, Hapseng achieved a higher gross profit margin of 29.77%, a return on assets of 20.01%, and a return on capital employed of 38.49%. These results show that Hapseng is more effective at generating profits from its assets and capital, making it a stronger choice for long-term investors. Secondly, Hapseng demonstrates a stronger operational efficiency. It records higher inventory turnover and total asset turnover, meaning it manages its inventory efficiently and converts its asset into sales more effectively. These strengths support sustainable business growth over time. Thirdly, Hapseng has a larger market scale, generating an annual revenue of 349.67 million compared to Apollo's 298.42 million. This larger revenue base reflects a stronger market presence and provides greater opportunities for future expansion. In conclusion, while Apollo Food is a safer company from a risk perspective, Hapseng delivers stronger profitability, better operational efficiency, and greater growth potential. Therefore, we believe Hapsang's Industries Berhad to be the more attractive investments for investors seeking sustainable long-term returns.
Thank you, Iqmal. Alright, so now we have reached the final part of our presentation. Looking at the summary table on the right, we can see that Apollo Food wins in liquidity and leverage. It holds a strong cash position and carries almost zero debt, making it a very safe and low-risk company. However, Hubsan takes the lead in profitability and efficiency. It wins 3 out of 4 profitability ratios and 2 out of 3 efficiency ratios. This shows that Hubsang is better at generating returns from its asset and capital. So, while Apollo Food is the safer choice, Hubsang gives better overall financial performance. Therefore, as a potential investor, our group recommends Hubsang Industries Berhad as the stronger long-term investment choice for investors seeking sustainable returns. And that brings us to the end of our presentation. On behalf of my group members, we would like to thank Madam Imarilda for the guidance throughout this course. And thank you everyone for listening.